Alrighty, so hopefully you should now start to be developing a bit of a basic idea around the concept of inducement, that essentially we need to look for where liquidity has been generated, ideally right in front of a POI, to increase the probability that there's going to be large institutional involvement. Big money is going to step in there to use that liquidity, in turn increasing the probability of that POI playing out. So again, what do we look at? Market structure. Okay, cool. That's a strong low because it broke a high. Then what do? Then we add in our demand zone that's strong because it broke the high. Okay, and what's the next filter we can look for? Did it sweep liquidity? As we've got a break of structure, right? If we sweep below like that, okay, perhaps that's even stronger sign now that this was a demand zone created by institutional involvement. It's backed by big money because they used the liquidity in the past below that low to make that movement there, okay? So that's the sweep zone. And then the next thing we're looking at is, do we either get liquidity built in the leg or built to the right, okay? So we would see, let's say we get another sweep zone, right? It sweeps liquidity below that low. Maybe there's a little bit of a pullback here, bit of a reaction from that supply there, right? And then price goes up. So now if you're looking at this POI, you've got some available strong liquidity there. And then if price pulls back, perhaps, we'll get some nice equals or maybe a low that breaks a high, right? And then again, you've got loads of liquidity building below that low, coming into our demand zone, and then we go, okay? So that's the general idea. Now let's kind of try and make this as systematic as possible and start to build our frameworks. Okay, so when you first look at this, it looks like there's a lot going on, right? It's a bit like, oh, where do you even start? It seems a bit like info overload, okay? So I will put a copy of this diagram and obviously one without the chart examples as well, just so you can have one that's a little bit more minimal if that helps you. But as always, we're going to take our time. We'll go through this. I'll explain it piece by piece. And if you follow along with me, try not to jump ahead. I promise you by the end, it will all seem a lot clearer. And there's not as much going on as you might initially think, okay? So kind of just did a little quick intro on inducement and what we look for. And now let's kind of make it a bit more formal, right? Really how I see it is there's generally only ever 4 scenarios that are going to build or we're going to look for when we're thinking about inducement, okay? And if we start from left to right, it will make a bit more sense. So the first scenario could be where there's just absolutely no inducement. So there's nothing built to the left with available liquidity behind it and nothing built to the right with available liquidity behind it, okay? So again, whenever I draw a box like that, that's when I'm showing there is no strong liquidity there, right? There's no structural low or high there for liquidity to be, and likewise nothing was built on the pullback. So this will be where you get a straight push, okay? And you'll often see this as well when price is really impulsive sometimes from news announcements. Sometimes you can just get like almost a vertical push in the market and there's no liquidity built. So you're looking at this POI, right? And yes, it broke structure, okay? But if you see no inducement in the leg to the left, okay? That is where you need to be a bit cautious, okay? Now, what I should have prefaced this all with, and I kind of wanted to apologize in advance, is I have introduced using some acronyms with these 4 scenarios, okay? So the reason why I'm apologizing is because this space is already full of enough ridiculous acronyms, but you know what? I think it actually helps to retain the information when you can kind of have almost these little names rather than saying all these long words every time. It makes it easier to teach. Hopefully it makes it easier for you guys to learn and retain the information. And also from a more practical standpoint, when you're doing markups every single day and drawing these out and doing your journaling and talking about it, if I don't have to type out these long words and you can just do a quick acronym each time, it will hopefully save you a lot of time in the long run. So what we're kind of saying in this instance is if there's no inducement, I've just put NID. I have no idea if I'll ever use that acronym again, but I just thought we'll put it in here and see how we go. Now, if there's nothing in the leg, okay, so this is the higher time frame leg that led to the break of structure. And we're calling that leg inducement, right? So lid, there's no lid, right? Again, I know this is ridiculous acronyms, but I think it will help to kind of retain all of this, okay? So we have the break of structure. There is no leg inducement. There's no lid. So if there's no inducement, ideally you want to see inducement built in the pullback, right? Pullback inducement, P-bid, right? But none is built. So if you're a big guy and you want to get long and you need liquidity, so you need people selling for you to buy from near where you want to be buying, if there's nothing here, there's no liquidity here, right, at this level, because there's nothing here and there's nothing to the right, there's no available liquidity, then where is the available liquidity? It's going to be below this low, isn't it? So you're more likely to buy down here because there's going to be all that sell side liquidity sitting below that low that you can now buy against, right? There's going to be a ton of orders here, and now you can buy against that to reduce your slippage. So more often than not, when you see nothing here and nothing here, the low is what's going to get swept, and then we can potentially look to play a sweep play here. Now, whether that's just a quick move, where we look to get long for a quick move like that, because price could then obviously be switching bearish, or whether it's a grab of liquidity to then fuel higher, we never know for sure, but that will come with using all of our other analysis, okay, multi-time frame analysis, where we are in structure, have we mitigated something here, right? We'll get into that as we get a bit more complicated. But for now, I just want you to think the general rule is there's nothing here to the left, nothing here to the right. So then where is the liquidity? It's going to be down here. So it's most likely that this is what's going to get liquidated, okay? So this whole time, just think about where is the available liquidity for BFIs? And if you can't see it, then you have to think, well, what is being induced? This low is inducing you to get long, to generate the sell side liquidity below it, and then they're going to use that down here, okay? So that's when you got no inducement, and this is an example of it. It's a bearish example, okay? So price comes down, it pulls up, it breaks structure. So you have a supply zone that broke structure, okay? So that could be an institutional zone. But as we can see, just a straight push, right? Nothing in the leg. And that's what I mean by when you get those straight pushes, they almost look like too obvious. They're almost too clean of a zone, right? And now I'm always skeptical when something always looks so clean. And over time, what I noticed was, you would get just stopped out and then it would go. And the reason why is because there's no liquidity for BFIs to use, right? And then the pullback, what do we get? Nothing. Price just pulls back up. There's no structural high there. There's no strong liquidity built just in front of the POI. So nothing here, nothing there. Where's the available liquidity? It's the highs here, right? So what does price do? Taps into that the buy side liquidity, and then it's most likely big money then stepped in to use that buy side liquidity to sell against. And then we continued to move, right? So if you see that, you think your POI has failed, perhaps then if you get the sweep and then you get your other confirmations, which we'll talk about, then you can look to get involved again, right? And potentially look for the continuation of the move, or just look for a quick play, right? Because it could just pull back into here and then we could be continuing higher, okay? But we'll get onto that in a minute. The main point I just want you to get is no inducement here, no inducement here. It's likely the low is going to be used, okay? Not always, okay? And I will caveat that. Like if this is a big, strong swing low and we've come into the very, very extreme, there might not be any inducement here and there might not be any inducement here, but if structure is going to stay bullish, then this is the place that it has to do it. So you may want to decide, depending on the specific scenario, that actually it's still worth the risk. I'm still happy to try and look to get long in here, okay? Okay, cool. So no inducement. Here is when we just have inducement to the left, all right? Leg inducement, lid, ridiculous name, I know, but it's there. Okay, so this is where you have inducement here. So when price is coming back down, it can use the liquidity, the available strong liquidity to the left below that low. If you're a big guy buying in, there's going to be sell side liquidity below that low, and you can buy against that. So if there is inducement to the left, that increases the probability of this POI holding. Okay, so like I said here, P bid may not be required, pullback inducement, right? Nothing was built here. So even though we just get a straight pullback, there's no liquidity built to the right, there's some available liquidity to the left right near the POI. So as price comes in and liquidates it, that may be enough sell side liquidity for the big money to buy against to fuel the next movement to the upside, okay? So here's an example, again, just flip it upside down in your mind, bearish example. Okay, so we get a nice sweep zone there where it sweeps a strong high, which is obviously lovely. Then we get a continuation, right? There's a pullback, we get a continuation of the move, right? So there's your break of structure, there's your high, there's your low. Okay, so we have the extreme supply zone that led to the break of structure. It's a little bit, I know it's a little bit zoomed out. Let me see if I can zoom in a bit. Okay, that didn't work, but yeah, but you can see here, there's a POI here as well. Okay, the decision that led to the break of structure, but hopefully if you can see, it's a straight push here. Okay, so we get the pullback, and then it's just one straight push. There's nothing in the leg there, okay? But above it, what does that become? That POI becomes this. It becomes the inducement, right? It induces sellers into the market. So it induces people to want to get involved in that supply zone. Where do they have their stop loss? Just above the high of that supply zone there, jumping around a bit, okay? So that generates sell side liquidity, buy side liquidity. Your stop loss is a buy order, okay? If you're short, you get stopped out. And then the big guys selling into your stop loss, your buy order, right, is what they can then sell into. Okay, so that supply zone here has induced sellers into the market to produce buy side liquidity, or more accurately, has just induced. Trying to get rid of the orange line, has induced. Essentially, that high there has generated buy side liquidity above the high. Okay. Cool. So that then becomes a high probability POI because it has inducement in front. Okay, so again, to visualize that would be sometimes what you'll see, right? You'll have multiple POIs when you've probably seen this now when you're looking at the market. Price has moved to the upside. We've broken structure and we're coming down, and there might be 2, 3, 4, even 5, 6 POIs to choose from. And now this is another concept that can help us, obviously with premium discount, stacking in other zones, right, etc., etc. But now if you can see that there is no inducement in this leg here to the left, right, and there's no inducement when price is pulling back, what you want to be saying to yourself is, okay, I might want to get long from this zone. It's pro trend on this time frame. Maybe it's in the discount, right? If you put on your premium and discount like this, okay, it's in the discount. So all you're going to say to yourself is there's no inducement, so I need to see inducement built to the right, okay? And if there isn't, then perhaps you can save yourself a loss because no liquidity has been built. So where is the available liquidity for BFIs? What is being induced? This low is being induced. That's where the available sell side liquidity is below, okay? So the exact opposite of what happened here. No inducement for this POI, so that was being induced to generate sell side liquidity for this POI, okay? Now again, just want to keep saying this is not 100% foolproof thing. There will be times where there's no inducement here, no pullback inducement, and it will go, okay? So it's just part of the game. So here, no inducement to the left, no inducement to the right. Here we have it to the left only. Here, there's none, we have it on the right only, right? So there's none on the left, there's no leg inducement, there's only pullback inducement. So similar scenario whereby we come up, straight push, nothing here, no available liquidity. So when you're coming back, at that moment when price is here, where I've circled, you're in scenario 1, no inducement. Okay, you're in the exact same scenario as here. So nothing on the left, nothing on the right. So you're just going to be patient because it's likely that this low is being induced and that's what's going to get swept. So you're being patient. So what do? You wait for pullback inducement to be built. And that's what happens if you're patient, right? So you might even get a mitigation, right? I haven't drawn it here, but sometimes it'll tap into the demand zone. It will break structure and you think, okay, I've had the mitigation. We've chalked it up now, we're bossed up, and you might want to look to get involved. But there's been no inducement built yet. There's been no liquidity taken, right? This is just a weak low. Okay, this low didn't achieve anything. So you want to see a strong liquidation, and then that's when we get a low that achieves something. We'll get into this in a lot more detail in a bit in the next lesson. But essentially that generates that liquidity now, that strong liquidity below that low. So now you've got it. Now you've got the pullback inducement. Okay, so now you be patient, wait for that low to get liquidated. Now you've got the liquidity generated. Now the big guys get involved. And that's when we try and get involved as well. Okay. And then lastly, as you probably guessed and seen, this is when we have it on the left and the right. Okay. So if I could probably simplify everything when it comes to inducement, first example is when there's none on the left, none on the right. So this is probably going to go. Here, if it's built on the left, then you've got a decent chance that will be enough. Here, if there's none on the left, but there is on the right, again, you've got another decent chance that might be enough because at least some liquidity has been generated. And here, if you have both, that's in theory always going to be the highest probability. Okay, if you have inducement to the left, if you have leg inducement, and you have pullback inducement, happy days. Okay, so kind of give you a little cheat sheet here. Again, this is not like scientific. This is just a rough indication of the probabilities. Okay, if you have both leg inducement and pullback inducement, so this example, in theory, that should be high probability. If you have one but not the other, so these two examples, you either have it on the left but not on the right, or you have it on the right but not on the left, then it's pretty decent. Okay, it's okay. Maybe you want to get involved. You have to consider other confluence, and then this is always going to be the worst in terms of this POI holding, right? Because you have nothing. So that's why I just say wait for more. Either wait for the low to get taken, right? And then if you want to, if it's in your plan, you can play the sweep, okay? And whether it's just a short move or if it's a continuation, that would depend on the scenario, okay? Or you're simply, again, waiting like we were here, because at this point, remember, there was no inducement in the pullback, so you just wait for that pullback inducement to be built. Okay, now I can get involved, okay? And that's pretty much it, to be honest with you. This again, it will seem like a lot, but it will come in time, because what you'll do is you'll do all your analysis, whatever, and you'll be looking for your POI, and it just becomes a question of, is there any available liquidity? Has anything been built yet? And you'll basically look to the left and you'll go, nope, okay, so I need to, and then you say, okay, I need something to be built here. And if there isn't, then you just sit on your hands and you wait. Okay, now when you get to this POI, is there any available liquidity? Yes, there's some here. Okay, cool, maybe I can get involved, right? And then you can get involved, or for some of you, you might always want to wait for both. Okay, so you're literally just, when prices come into your POI, you're just asking that question, where is the available liquidity? And if you can't see it, then it's probably likely that you're about to be induced, okay? That's the phrase that people say, if you can't see the liquidity, you are the liquidity, right? And that's kind of generally where this comes from, okay? So again, some silly acronyms up here, but hopefully it kind of helps to speed things up going forward. But SLQ, strong liquidity, basically my way of saying when you've got liquidity behind a strong piece of structure, right? We want it to be significant. This, I wouldn't say is strong liquidity below that low because that low has not achieved anything, right? But when this achieves something, it breaks it, now you have strong liquidity below that low, okay? So available liquidity behind strong structure, or if you get like very obvious and clear equal lows like that, equal lows are highs, okay? So available liquidity for institutions to use to enter the market, okay? Lid, I know I'm rolling my eyes myself at this, but sorry. Leg inducement, okay? So this basically just means inducement to the left. You might even want to call it left inducement if that helps you to think about it, right? And you want to see, again, that strong low builds that available liquidity to the left, right? Leg inducement. So generates available strong liquidity built on the leg to the left. This is a key point as well that I forgot to mention. It must be on the same time frame as the POI you were looking at, okay? So let's say you're more of a swing trader and let's say you use M15 entries, you're going to be trading 4-hour ideas, okay? So 4-hour time frame is going to be your main time frame, right? So if you're looking at these 4-hour POIs, what you're going to be doing is you're going to need to see 4-hour inducement to the left, okay? So for a 4-hour POI to have inducement, it needs to have a 4-hour strong liquidity in front of it, right? That's a 4-hour low, so this 4-hour POI has 4-hour leg inducement, okay? It has to be, the leg inducement specifically has to be on the same time frame you're looking at. Now, if it doesn't have leg inducement, so we're here, and obviously you can wait for the pullback inducement, this can be built on your lower time frame, your execution time frame. Okay, so again, if you're a swing trader, you'll be looking at the 4-hour chart as your main time frame. There's no 4-hour inducement here. There's no 4-hour leg inducement because there's no structural low there. Okay, so what you do, you need to wait for it to be built here. Okay, and this is where you can look on the M15, your execution time frame, and you can wait for the pullback inducement to be built on your execution time frame. Okay, if it's built on the 4-hour chart, then even better, right? Because it's going to be even more significant. Okay, so again, leg inducement must be on the same time frame. Pullback inducement can be built on your lower time frame execution when it comes into your higher time frame POI. Okay, so pullback inducement, basically inducement on the right, that generates strong liquidity built in the pullback on the right, and it can be on your execution time frame. Okay, so again, if you're an M15 trader, you're going to be looking at 4-hour POIs with M15 execution. So you need 4-hour to the left, and the pullback can be on the M15. Okay, if you're a day trader, you're most likely going to be looking at M15 ideas, right? So you need M15 inducement, and then this can be like on the M1 or the M5 when you're using your lower time frame execution. Okay, again, we'll get into the entry models in a lot more detail in the next lesson, but I kind of wanted to just give you the sort of more general overview. Okay, so watch this as many times as you need. It can feel like a lot to take in. You feel like you have to think of all these scenarios, and I get it. But honestly, it will literally come down to when you're in the market and you'll be looking at a POI and you go, right, am I just going to get involved with my entry model when we get here? Or you just go, well, hang on, is there inducement to the left? No. Okay, I'm going to be patient and wait for it to be built to the right. If you're down here, is there inducement to the left? Yes. Okay, well then perhaps I can get involved without waiting for pullback inducement. And that'll be it. You're just asking, is there available liquidity? Okay. And generally there can only be these 4 scenarios. Maybe there's another one, I can't think of it, but no inducement left or right, on the left, not the right, not on the left, on the right, both, okay? So yeah, and there's some examples actually, I didn't go down here, I'll just end on that. So this is an example, right, where you have no inducement in the leg. It's a bit hard to see, I know it's a little bit zoomed out, but essentially there's no structural low there, right? No low like that, it's just one straight push. So when we come back, what do you have? You have no inducement. So what do you want to wait for? You want to wait for pullback inducement to be built. So here we've got some nice, clear, obvious equals, right? Like see like big moves away. Clear like double bottom there. What's also better is it broke that internal high there as well. Okay, so you get that strong low. Now you've got your pullback inducement. Now you can look to get involved. Okay, here we have both sides. So here, just a little bit of a pullback, nice and near the POI. What's even better is you get kind of like relatively equal lows there. But what do we also get? We get lows that are breaking highs, right? Breaking those internal highs, inducing more sell side liquidity into the market, right? Whether you're buying, you've got a stop loss there, or whether you want to sell the breakout of those lows, right? It's inducing traders into the market to generate sell side liquidity. So now we have it. We have leg inducement, we have pullback inducement, right? Left and right. So now it's a high probability POI, purely thinking about inducement, okay? Obviously you need to use all of your other concepts and everything. You're not just going to go, okay, there's inducement, this has to be a POI. Like you need to be thinking about everything. This is just another tool now, another layer we're bringing in, okay, into